Jeevan sir. By education, he did his B in mechanical and MTech from IIT Kanpur, and he's a CFO holder. And he runs a PMS, SEBI registered PMS by the name of Sahasrar, and he also runs a family office and CIO. So for Sahasrar Capital, the SEBI registered PMS, he is the director and principal officer. And as everyone is already aware, like he shares his thoughts over his Twitter handle. And very warm welcome, sir.
Thank you. Thanks a lot, Prince. So today, I think we're going to discuss about equity investing. So I have been on YouTube and Twitter a lot of time spoken about investing in equity market in small cap and mid caps. So since we are SEBI registered PMS, there are certain restrictions that I need to follow. So so whatever I write on individual stocks on Twitter, I think that's the way I basically try to share my understanding and knowledge about my portfolio stocks. Beyond that, I don't think I'll be able to get too much of detail in those about those stocks. So maybe we'll just keep some of the stock related questions. So I won't be able to speak in too much of detail on any of those portfolio stock as such. But we'll restrict ourselves to more towards investing in small cap and mid caps and growth investing. So I don't follow actually value investing approach, honestly. I am typically follow growth investing approach. So we'll restrict ourselves to that. So maybe Prince, you can start directly question and answer, and I'll try to answer some of those questions.
Right, sir. Fair enough. So, guys, during the conversation, if any names would be taken, those will be purely for educational or illustration purposes. So, no sort of buy sell recommendation by any means. Please do your own due diligence and take today's learning as a starting point. And in case of any investment, consult your financial advisor. So, Jeevan sir, let we begin with a very basic question when it comes to investing journey, how it evolved over a period of time, and what were your major learnings throughout the tenure of say 20-25 years of your investing journey. Yeah.
Okay, so I'll just start with how I started in the stock market. So I started. So I was working in an IT field. So I was working as a software engineer in IT company in 2002 to 2008. So I started investing in market in 2005. So when market was actually down, so after I think there was a change of government and the market actually went down, and that's where basically I started investing in market. So that time I was in IT field, so not having any background of investing in stock market. So when I started, there was no rules, no principles, no framework. So I just used to invest in stock based on the price action and all that. Okay. So even I was not knowing any technical that time. So it was purely based on the screen and all that. So that's how I started in 2005. From 2005 to 2008, 3 years, the stock market actually went up. So there was actually a big rally in the market, and everybody know that. So market went up a lot, but I actually didn't make any money. In fact, I lost a lot of money in these 3 years. The learning out of that is basically you need to have some kind of framework. You need to have some kind of thought process behind when you invest in the stock market. Because in these 3 years, actually, when the stock market actually went up so much, I actually lost all my capital. Okay. So then I basically thought I should actually develop some kind of framework. And that's where I did started doing CFA. So I completed my CFA in that period, 2008, 2009. In 2008, actually, I shifted from IT to investing profession. So I would say. So I joined a private equity fund in 2008 September, exactly when just 1 month before the Lehman crash. So that's the time when I actually joined, or I shifted from IT to stock market. And I remember those days when I used to go to office every day, and every day there was a horror movie. Okay, So every day there will be stocks falling by 10%, 15%. Every day there was a new low in the market, and I was not able to understand what's going on. But I had people around me which were very experienced people. I don't want to, so I can name those people actually. So I was working in Axis Holdings private equity fund. Okay. And so I was working with Kuntal Shah. I was working with Manish Jain. I was working Samit Vartak. So we were actually 4 5 people actually in that Axis Holding private equity fund. So so that 1 year, I would say not 1 year, but it was 6 months or 7 months, was a very painful period, and we all were actually trying to understand what's happening, because it was very new to everyone actually, because stocks were actually trading much below their intrinsic values. Okay. And but that's when basically we started to, so that's the first learning experience for me, from because I was very new to the stock market, not having any experience in the stock market, professional experience I should say. So not having any professional experience in the stock market, so that was a very new to me. So that was the first learning phase for me, where I actually understood how the liquidity drives the prices in the short term. And if someone really understand the business, and if he is able to understand the real intrinsic value of those businesses, then these are the best time to invest in the market. Liquidity drive prices in the short term, but what drives stock prices in the long run is the business fundamentals. So I remember some of the stock which we actually bought that time in 2008-9 crash, which actually became 50x 100x in subsequent period. So the learning that period was, liquidity drives the stock prices in the short run, but in the long run what drives is the business fundamentals. So if you are able to understand the business well, then these are the best times to actually invest in the market. And these are the time when one should actually when should actually become bold and put take a big bet actually. So that time I was not having enough money actually to take that big bet, but whatever money I had, so but that money actually multiplied much faster and much bigger. So that was the first experience or the learning in the stock market. Then I worked there for almost 3 years. So there I was working on power sector, so power, coal, minerals, then steel. So these were the sector I was looking at during those 3 years. And my thought process is behind investing in those sectors was that time in 2000. So I'm talking of 2009 to 2012. So my idea or my thought process that time was, the people who are having access to coal mine, or people who are having access to the iron ore mines, these are the people who can make actually obscene amount of returns, because that time it used to be allotted, and it was not auction, but they were allotted. Okay. So coal mines and iron ore mines, all mineral, actually used to allot by the state government or the central government. And the companies who are having some background in those particular sectors, or the companies who are there in that particular state for say 10 years, 15, 20 years, they used to get those licenses. And once you get the license of, for example, if a company, say, look at Jindal Steel and Power. Okay, I'm just giving one very good example. So in Jindal Steel and Power, I remember one time it was trading at some 10 rupee or 5 rupee stock, but they were having access to huge coal mines, and they were having access to iron ore mines. So they put up a merchant power plant that time, and in merchant power plant they were able to sell the power at around 6 rupees, 7 rupees per unit, whereas the cost of making that power was almost around 2.2, 2.3 rupees. So they used to make obscene amount of profit. So if you actually see that period 2009-10, then you will see that Jindal Steel and Power actually made huge profits. Okay. So the idea behind investing in that particular sector is to find people or find companies who are having huge resources with them and invest in those companies. So Sandur Manganese is another example, or Sarda Energy was another example. So these were companies having access to coal mines or iron ore mines, and based on that, they can actually reap a lot of profits in the future. And that's the thesis with which I actually started investing in that particular sector. In 2012 or 13, I don't remember exactly the year, but that's when basically I basically saw that, you know, what can happen in these kind of sectors, because they are more regulated sectors. So when government actually or Supreme Court actually scrapped all the licenses of coal mines or iron ore mines, and they basically auctioned those mines. Okay. So that's where basically I realized what can happen to these regulated sector, and that's where basically I decided not to invest in any of these sectors. So that was the second learning, that I decided that I don't want to invest in any of these sectors where there is a government intervention, where government policies can change and they can change the dynamics of that particular sector. So that was second learning, that I don't want to invest in any of the government sector, or any of the sector where government intervention can change the dynamics of the sector. Then I started my own in 2012 and somewhere around August, September 2012. So before I started my, so that time I started with one family office. So started managing their very small amount actually that time. So I started managing that fund, very small funds. So before that, I spent almost 3-4 months just to put my investment framework, just to design my investment framework. The idea was very simple. The very only objective I had in mind was, whatever it is, I don't want to lose the capital. The return will come automatically, but I don't want to lose my capital. And what are the ways in which I can manage the portfolio so that I won't lose any capital, because that's a client's money and that's people's money. I can't lose the capital. So that was the only thought behind designing that framework, and I took almost 3-4 months just to think over it and design that framework. And then after I started, so I designed that framework, and then when I started managing family office funds, I started with that particular framework from 2012 August somewhere. For almost 10 years, I managed based on that framework. And in 2017, I think 2017, I just made some. So there are so in 2017 there was a mid cap rally, or there was a small cap rally, right? And then after, from 2017 to 2020, there was actually mid cap, small cap actually gave a very bad return, almost minus 40% kind of return. And that's when basically I realized the power of the framework. So that time I was able to give positive 10% return, and that's where basically I realized was, this is the framework that I should be stick to. And so I am following that framework. There has been some revisions, there has been some improvements in that framework. So there are certain things that I change over the time. But I think I got a framework where I'm pretty confident that at least the capital will be protected. Returns are basically a byproduct. If you are able to manage risk well, the returns will definitely come. And that was the philosophy with which I am doing it since last almost 10 years now. So this is the story. So as I said, there is first learning was obviously 2005 to 2008, where I understood that you need to have a framework in place. Without framework, if you do investing, then you will not be able to make money, irrespective of whether market goes up or down. But if you have a framework, then irrespective of the market, you will make money. So that was the first learning. Second learning was, whenever there is a liquidity event, both on upside and downside, it actually gives you opportunities. So when there is a liquidity crisis, that's the best time actually to invest in the market and to pick the businesses with the right fundamentals. Third was not to invest in sectors where sector dynamics are much more dependent on the government policies. That was the third learning. And fourth, obviously, throughout these last 10 years, there has been small learning which actually helped me to improve my framework. So I think that's what it is.
Right, sir. Sir, like when it comes to value and growth investing, the house is divided. There are people who consider growth as a part of value investing, and you keep it separate. So now, if we talk about growth investing in your point of view, what are the triggers or recipe for multi-baggers, in your opinion?
So I typically say that in today's world, data and information is commodity. Everybody has access to data and information. That's there, abundant, available on the internet. So what differentiates you from other people is basically your vision. So because everybody is having access to that data and that information, but everybody will interpret it differently. So if you are able to interpret it better, and if you are able to develop your vision based on that interpretation, that's where you will be able to make the multivags. So it is all about the vision and the interpretation. So better your understanding about the business, I think your interpretation of that data will be better.
Right, sir. So, if we talk about generating ideas, or how you zero in on any stock idea, or maybe, sir, any investment, how you go about it? What are the filters, maybe?
So today it's very easy for me because I have a framework. So I typically say that it's always important to have a elimination framework rather than selection framework, because there are almost 5,000 stocks in the market. So if you don't have your elimination framework, then what will happen is every day you will get one or two new ideas and you will keep working on these ideas every day. So you will spend more time on just looking at different ideas. But if you have your elimination framework in place, then you can eliminate ideas faster. So today, if I get any idea, I can eliminate that idea within a second. So I don't even spend more than a minute on that idea to eliminate. And that's where basically I get a lot of time or ample time to work on ideas which are selected. So what is important first is to have an elimination framework. What are the things that you are not going to invest in? If you are very clear on that part, then I think that makes your life very easy. So that elimination framework should actually should be the first thing that you need to have, so that out of that 5,000 ideas, you can eliminate 4,500 ideas immediately. So you have only few ideas to work upon, and that's where you get ample time to work upon those selected ideas. So first is elimination framework, second is selection framework. So once you eliminate the ideas, then you need to see whether whatever ideas are selected, out of that, which are the ideas which actually fits in your framework. So there will be only few ideas. So I would say,
Right, sir.
so today after 10 years, if you ask me how many stocks will actually pass my selection framework, there will be not more than 150 200 stocks which will pass the framework. So since the number of ideas itself got down, I have ample time to work on those ideas.
All right, sir. So we have Sajal sir and Shashank with us. So Sajal sir, you go first, and yeah.
First of all, hi everyone, and thanks Jeevan Bhai for spending some time with the community and just helping us out with your thought process. So whatever you said about the framework and the elimination, including avoiding B2G, business to government, or anything that where the cash flows are a function of getting the payments from the government, I agree 1000% with that. And that's precisely the reason there are certain sectors that I don't even include in my watch list. So
Correct.
yeah, that's 100% correct. So I understand that this is not the right, we are recording this session, so this may not be the appropriate platform to ask stock specific questions. But given your understanding of the chemicals space, including the APIs, what I would like to understand is what are the antithesis pointers for this whole space, because there are thousands of molecules. My understanding
Right.
is that the antithesis is a function of the molecule itself. So which product and which market. That's the sort of where I base my antithesis. But I would like to understand your framework in terms of how you classify these thousands of molecules, and where the possibility or the probability of making disproportionate gains are larger.
Sure. So I'll briefly talk about the framework that I have. So there are five steps, or there are five factors in that framework. One is right sector, second is right business, third is right management, fourth is right allocation, and fifth is right price. The first three, right sector, right business, and right management, are basically related to the selection part. Right allocation, right price relates to the allocation part, and both selection and allocation actually gives you the portfolio returns. So when I comes to the first part, the selection part, when I say right sectors, there basically I say that pharma and chemical are one of the best sector. So chemical, I would say more appropriately, because pharma, again, there are very few investable opportunities for me as such. So chemical is basically the sector which I feel is the right sector, because so when I say right sector, there are few criteria of right sector. One, so typically which I define as a structural sector, so where there is a runway of next 10, 15, 20 years. So chemical falls under that particular criteria. In 1990, 192, IT was one of those sectors which has a lot of tailwinds, and so that was one of the right sector that time. Today, even consumption will come under the right sector. So there are few criteria to define the right sector. So chemical is definitely one of those criteria which comes under the right sector. When I say right sector, then comes the second, right business. So when I look at, say, for example, let's say IT sector, okay. So in IT sector, there will be always two type of businesses. One will be commodity business, other will be specialty business, and this is true for every sector. Even if it's automobile sector, there will be commodity businesses and there are specialty businesses. So in automobile, for an example, Sona Comstar will be a specialty kind of business, or uh, Varroc Engineering, or maybe some other business which is more like an OEM or supplier of certain parts to, say, Maruti or Bajaj or Hero Motors. They will be more of a commodity businesses. When it comes to IT, I would say Wipro or TCS or Infosys, they will be more of a commodity businesses, whereas Tata Elxsi will falls under specialty business. When it comes to chemical, I would say something like Make Money Organics or GHCL or Tata Chemical. They will be like commodity chemicals or commodity businesses, whereas specialty side, I would say the specialty portfolio of Deepak Nitrate or Neogen Chemicals or Poshak or previous specialty. So these are specialty chemicals. So first is right sector, where I say chemical will be or IT will be a sector which falls under that. Then comes the right business, where I say that I typically follow the specialty side of it. Certain people follow the commodity side of it, because in commodity also you can make money if you are able to time the cycle right. So if you look at, say, IT, okay, if you are able to time the cycle right in IT, then you can make good money in IT as well. But specialty side, I typically follow only the specialty side, because I feel there you don't need to time the market, you don't need to time the cycle. You can stay invested for very long term, and the returns will be compounded every year. That's where basically I follow the specialty side of it. So in chemical also, I will follow the specialty side of it. If I look at pharma, as Sajal bhai was asking, so in pharma side, I will not go for the commodity side of it. which is a generic space like Lupin, Cadila, Dr. Reddy or Aurobindo or Strides. So I will not follow the commodity side of it, but I will try to follow the specialty side of pharma, which will be something like Syngene or CDMO players, Suven Pharma or Laurus Lab. So I will try to look at the specialty side of the pharma. If I look at even in the pharma, so as you rightly said, there are thousands of molecule actually on pharma side. So you need to really see that which molecule and which geography or the which country the opportunity is. But more than that, so I don't get too much on the molecule level. I would rather say, in this case, I would rather say that let's pick and choose the promoter. So right sector, right business, and then third was right management. So this is what is important. So if you don't need to get and understand each and every molecule, you need to put your bet on the management. If the management is right and if the management is smart, then he will do that job for you. He will pick the right molecules, he will pick the right opportunities, and he will grow the business for you. So there, your job is actually little easier. So just to give an example, so as I always keep talking about Laurus on Twitter, I'll talk the same stock here as well. So when I picked Laurus Lab, one of the aspect was, as I said, right management. So I like Dr. Chhawa when I chose Laurus Lab because the principle of R&D first. So he started the company with R&D and then he got into the manufacturing. And that's the philosophy which I liked about the management. And that's where basically I liked Laurus Lab. Second is the way these people are able to scale up or these people are able to diversify. So initially it was an ARV company. So they were, so almost 100% was ARV business. Then they started diversifying into non-ARV businesses. Then they diversified into CDMO. Then they acquired a small biologics company. Maybe after 5 years, biologics itself will be 10% of the top line. So it's all about the management. So if the management is right and if it's smart, then he will try to choose the right opportunities and he will grow the business for you. So that's where, so that is what my strategy is. So I don't go and look for each and every molecule, because if management is not right, then even if the current molecules are good, in the future it's not guaranteed that so I was basically saying that instead of focusing on which molecules right now company is into, I will try to focus on the right management, because if the management is right, they will choose the right molecules for them and they will grow the business. Because if the management is not right, even if the molecule is right, it's not guaranteed that in the future they will continue with the right molecules. So that's where basically I'm more focused on the management than the right molecules.
That's helpful, Jeevan bhai. Just maybe a follow on. So you mentioned few companies there, but if we look generally, so let's take an example of Navin Fluorine, and again a disclosure. I've spoken a lot about Navin Fluorine, including the risks related to the valuations. The reason I mentioned Navin Fluorine is that none of the Indian chemical companies are a pure play specialty.
Okay, so in
Right. So how do we value? So Naveen started the journey below book value. So I've been tracking this business for almost 10 years now, and they started their journey below book value. So you pivot yourself, justifying that this business has got commodity elements, and they still have got commodity elements. And like any other chemical company in India, I have not seen 100% pure play true specialty chemical company in India. And when I look at the valuations, I find कोई 10 time book पे है, कोई 12 time book पे है. तो कुछ मनमर्जी का valuation चल रहा है, because the music is on and people are buying them at those valuations. When I look at other companies that started their journey, so Lonza as an example, or Croda here in the Europe, they are the true specialty chemicals. They started as specialty chemicals, and they were never into commodity,
Hmm.
and they just started going up the value chain. So what started as a chemical company today is in gene therapy, as an example. Whereas if I look at the Indian businesses, none of them, not a single company is a pure specialty company in India.
Okay.
So how
So,
should we value? What is the right valuation criteria?
okay.
Thank you.
So, so on Navin Fluorine itself, so this is a best example of what I said. So, as I said, you need to bet on the management. If the management is right, they will choose the right molecule, they will choose the right opportunities, and they will grow it. So just look at the Navin Fluorine example. Okay, last 5 years. So I have been invested in Navin Fluorine earlier. Right now, I don't have it, obviously because of the valuation part. But if you just look at the last 5 years, so Navin Fluorine has started its journey only after there was a recent change in the management. Once the management, so there was a change in management. That's the time when that stock actually got re-rated. So I just give you example what has happened actually in Navin Fluorine. So earlier management was actually guiding for capex of somewhere around 200 crores when the market cap was 5,000 crores. And that's where basically I was like, why these people are guiding only for 200 crore capex when the market cap itself is 5,000 crore? How much these people will be able to grow with this just 200 crore capex? When the management got changed, that management actually announced a big capex. And that's where the complete re-rating happened. So that management actually got a new contract, that management actually sensed the opportunities in the fluorination. And that's where the complete fortune had changed for the Navin Fluorine. So I remember the stock is going from 700, 750 rupees to straight 2,500 rupees after the management change. And when they announced the new capex. So that's what happens when you have a right management in place. Second, on specialty chemical side, so as you said, there are very few companies. You don't know any companies which are truly specialty in India, but I would say there are few. So if you look at Paushak, it's completely specialty chemical company. They don't do any commodity products. It's complete specialty, so 100% pure specialty company. Earlier, they were doing some commodity products, but the product portfolio or bouquet has been changed since last 2 years. It's been a pure play specialty chemical company now. Again, disclosure, I am holding Paushak. There are few more companies which are pure play, I would say, specialty companies, apart from this Paushak. So Aether Industry, if you know, again, this is a pure play specialty chemical company, but obviously the valuation is too high. But that's a pure play specialty chemical company. So there are few companies which are pure play specialty chemical companies. Now, when it comes to valuation part, I always keep saying valuation is a function of two parameters, and I call them gods of valuation. These are the only two parameters I would say which actually decides the valuation. One is your return on capital. Second is your growth. Return on capital ensures that you have certain moat in the business. So if you have better return on capital, obviously you will have certain moat in the business. Whereas growth ensures that you are able to generate returns for your shareholders. So if there is a high return on capital but no growth, those businesses can't get better valuation, good valuation. Vice versa, if there is a good growth but no return on capital, again these people won't get the valuation. So return on capital and growth together decides the valuation of a company. So if certain company is doing say 40% return on capital, then theoretically, if that company is having enough growth opportunities, then that company can grow at 40% without any external funding. So I'm talking theoretically here. If they have more growth opportunities, then what they will do is they will actually get funding from outside. So they will dilute some of the equity, and they will try to grow more than 40%. So they will grow more than the return on capital. So something that has happened with the case of Bajaj Finance. So Bajaj Finance has a return on equity of 20%, 21%, but they were able to grow at 40%, 45% for last few years. And that they are able to do by raising more and more equity at a higher price, right? So if the company has enough, so that's where I said growth is also very important in addition to return on capital. So if there are no growth opportunities, then even if you have 40% return on capital, you won't be able to grow at 40% because you don't have enough growth opportunity to reinvest. Growth always comes from reinvestment, and reinvestment will happen only if there are enough growth opportunities. Lot of time what happens is, since the growth opportunities are not much, companies will try to reinvest at a lower return on capital. So incremental return on capital will be low, and in that case the valuation should also go down. So I think these are the only two things, return on capital and growth. I think these two things will decide the valuation. So some company is able to do 40% return on capital and that company is having enough growth opportunities, then I would say 40 P multiple is reasonable for them, is a good multiple for them. If these people are having 40% return on capital, but the growth is 50% or even 30%, I would say, still I would say 40%. So when we look at the valuation, these two are the most important parameters. But in addition to this, there is one more parameter which people typically ignore, and that is the, I would say, what you can call the liquidity. So there will be very few companies to chase. So too much of liquidity will be chasing too few companies, right? And there is also something called as required rate of return of an investor. So if some FII is having his cost of capital as say 6%, 7%, and his required rate of return is say only 12%, right? And if he is able to see after 3 years, this particular stock is going to be say 5,000 rupees, then he will be ready to invest even up to 4,000 rupees today or 3,700 rupees today. So that's where basically the multiple actually goes up. So if you look at Navin Fluorine, that's what that can be the justification of the valuation. So if I am an FII and if I am able to see that this stock after 3 years, even with 40 P multiple, is going to give me 12% returns from this value, I am okay putting money in this company at this particular valuation. What is important here is the certainty of the earnings of the business. So if there is a lot of certainty about the earnings of the business, then people will be ready to give higher multiple, because they are very certain that they will get that 12% return from this company for next 3 years. So they will be ready to put that kind of valuation, and that's what is happening in a lot of consumer stock like Asian Paints or Pidilite or Nestle or those kind of stocks, because there people know that there is a certainty of earning growth, and the risk to the earning is very, very low. So there I am ready to give multiple of say 70 or 75 as well, because I know that my cost of funding itself is very low. So yeah, I am happy even if I get say 9%, 10% return. But if there is a surety of return that I will get that returns, then I'll be happy giving even 70%, 70 P multiple. So I think P multiple has multiple parameters to it. So growth and ROC is the fundamental parameters, but apart from these two fundamental parameters, I think liquidity and investors' rate of return, these two are also very important.
No, that I agree, Jeevan bhai. But my personal experience is my best investments have been those where the growth was missing and the ROC was pathetic in either single digit or 10
So that
12%,
is
that
where,
kind of
so
ROC.
that's where
So the
basically,
chemicals as an
yeah.
example,
So
yeah.
that's where basically you will make multi-bagger returns. because you are basically playing on multiple levers in that company. So you are playing on
Correct.
sales growth, you are playing on margin expansion, you are playing on ROC expansion, you are playing on PE expansion. So if you are playing
Absolutely.
on these
Yes.
many levers, definitely it's going to be a multi-bagger. But I'm just trying to tell you why people are ready to give 50 PE multiple, 60 PE multiple to a particular specialty company, because there they see, there they have the visibility of growth for next say 3 years, next 5 years, and they are happy with say 12% returns for next 5 years. I think that's where they are ready to give that kind of multiple to those companies.
Yeah, but if an accident were to happen, right, and things go horribly wrong, and that's where the antithesis comes into play, right? So there could be an environment concern, there could be a regulatory compliance issue, it could be anything which was not part of your original thesis, because best risks are those which are not included in our thesis,
Yes,
right? So
yes,
if
yes,
anything of that kind
yes,
happens, then the valuation engine will be just shut off,
yes,
right?
yes.
So valuation engine will just shut down, so all you are left with earnings, and even earnings will start going down. So it would be like a aircraft with, there's a lost his rudder.
So that's
So
where
then there
basically,
is no
so
saving.
that's where I basically say that I don't advocate buying at any price. So I typically say
Hmm.
that you should buy only if the price is reasonable. So when you buy
Correct.
at a higher price, obviously one bad thing and you are exposed. So
Yeah.
there are multiple things that can happen. So earnings can go down, ROC can drop, your P multiple can drop. So multiple risks are there at the higher price. So obviously, I don't advocate anyone to buy at any price. I typically say that you should buy at. So your buying price is always important.
Yeah, sure. I'll go on mute. I'll let others ask their questions. I imagine there'll be a long queue of people waiting to ask you one thing or the other. Thank you.
Thank you. So, Jeevan sir, like when it comes to risk, how you define risk in your investment framework? How does it fit in, and what all you see so as to manage the risk?
So as I said, I think if you understand my first three parameters, right sector, right business, and right management, if you are able to do these three things, I think you are taking care of the risk to a larger extent.
Right. And sir, I heard your interaction previously. Like you talked about the volatility is in the not in the price, but it is in the earnings.
So risk
So would
is
you?
all. So what I say is risk is not about volatility in price. Risk is all about volatility in the earnings. So just look at, so recently I think Motilal Oswal presented their wealth creation study, right? So there they have actually given all the data and everything to support this one statement only, that it is all about volatility of earnings and not volatility of price. So the companies where there is a more volatility of earnings, they will be laggards, and the companies where earnings volatility lesser will be the wealth creators. So I think that was the bottom line.
And right, sir. And you also talked about in terms of portfolio as a whole, like this allocation part is important
Yes.
in comparison to selection part.
Yes.
So what's your?
So
Yeah.
that's where I said, so right allocation and right price. I think these two important parameters when it comes to managing the allocation risk. So,
Right.
when you say that risk, so in portfolio management is all about managing the risk. So how you manage the risk? First, by having the right allocation, and second, to buy at right price. These are the only two ways you can actually manage the risk in the portfolio, right? Obviously, selection, so right sector, right business, right management will manage the risk in the selection part, but in the allocation part, right allocation and right price. I think these two will help you in managing the risk.
Right, sir. So, sir, what's your view on diversification? Like how you read it?
So as I always keep saying, I don't believe in too much of diversification. Obviously, you need to have the diversity. You can't have one or two stock in the portfolio. So 10 to 12 or 13 stocks may be the right portfolio mix. Because, but again, as I said, so unless and until you have good business understanding, then only you should have this kind of portfolio, what we call the concentrated portfolio. If you don't have good business understanding, then it's better to have a diversified portfolio. So typically people who doesn't have understanding, that's where they basically go for diversified portfolios. If you have good understanding, then you will go for concentrated portfolios. So so it is always directly proportional to your level of understanding of the businesses. If your level of understanding of the business is higher, your portfolio will also be more concentrated.
Right, sir. So, sir, if when we talk about small cap space, the information is limited, and as you rightly say, there is lot of hard work which is required from investors' point of view. But again, if one has to start today, how one's approach should be like so as to master the space? Because a lot of hard work we agree, but there has to be some way, or you say which has worked for you. If you would like to tell us.
This is a difficult question actually, Prince, because there is no method of, there are different ways of learning in the small cap. So the only thing I can say here is, if you have this right sector, right business and right management framework in place, then you can avoid a lot of mistakes. So you don't need to go after each and every small cap and each and every micro cap. First, see whether it fits into your framework. If you do that right, I think you will avoid 90% of your mistakes. The rest 10% can be avoided with the hard work, but 90% can be avoided with this framework.
All right, sir. So we take one question from Usman. Usman, you can unmute and ask your question. Usman, you are still on mute. You have to unmute and ask your question. You there?
Hello, can you hear me?
Yeah, Usman.
Yeah, go ahead.
Yeah. My question is, what's your thesis on buying NSE instead of some listed companies like CDSL or CAMS, for that matter?
So as I said, I don't want to put my thesis for each and every stock that I'm holding. I think I have put lot on each and every stock on the Twitter, so you can maybe read those tweets about individual stocks. But there's no point in talking in detail for each and every individual stock.
Right. So Vishal Krishna, you can unmute and ask your question, and please make sure it is not stock specific.
Yeah. It's not stock specific, but just it's a generalized question. Like I'm taking just for reference, so SRF. So we know it has been a multi-bagger and it has it has created multiple times. Well, but for reference, but just example, I'm asking. As the market cap keeps on increasing, right? Do we see the same growth which it has performed previously? Can we expect the same going forward? We know they are been expanding and all. Can we expect the same performance which they have done past, and can we expect the same in future as well?
So you're talking about SRF, right?
Yeah. Example
Okay,
I've
so
taken, but there are Atul and many are there.
I don't hold SRF in my portfolio, but just to give you a broader answer, right? So what I like about SRF is the way they have done the capital allocation. So earlier I used to be very negative around 2015, 2016. I was actually negative on SRF because they were having a huge earnings coming from their packaging division, and that's where basically I was like, I don't want to invest in this stock because majority of the earning coming from the packaging sector. Even today, if you actually see, 50% of the earning come from packaging and the tire technical textile business, right? But the smart thing that they have done is they have actually earned a lot of money in the commodity cycle in the packaging business, and they utilize that cash to deploy in the chemical business. So they have actually built their specialty chemical business very well. And in fluorination part, I would say, so if you look at the fluorination chemistry, there are three players majorly. One is Navin, second is SRF, third is Gujarat Fluoro. So everyone has picked different sectors within the segments, I would say, within the fluorination. So Navin works more towards pharma and consumer. SRF works more towards agrochemicals, and Gujarat Fluoro works mostly toward polymers, fluoropolymers. So everyone has picked, different segments within the fluorination. So each one has its own advantage, disadvantage. So in case of pharma side, obviously you will have a small, so contracts will not be like 10-year contract. They will be smaller duration contracts, but better margins. They will have better ROC. In case of, but the size will be smaller, the duration will be smaller. In case of agrochemicals, the duration will be long, like 10-year contracts. The size will be again very big compared to pharma contracts, but the margins and returns will be lower. So every business has its own advantage, disadvantage, but these three people actually picked very well. So they have actually picked different segments within themselves. So there is fluorination has a good growth in the future. So be it Navin or SRF or Gujarat Fluoro, I think there is a good growth for fluorination chemistry because all the new drugs. Yeah, so all the new drugs that are coming, majority of those drugs will have fluorination. Agrochemical, majority of molecule will have fluorination because fluorination is basically good to. It's a So in technical terms, the last reaction, if you carry out the fluorination, then that gives better efficacy to the molecule.
All right, sir. So Rahul, quickly unmute and ask your question. We are left with only 7-8 minutes, so we try to take as many questions as possible. Yeah, Rahul, go ahead.
Thank you very much. Thanks for the opportunity. My question to Jeevan sir. Jeevan sir, I want to ask what should be the criteria to be follow for selecting the private sector banks? Like if one small private sector bank is having ROA of more than 1%.
I tell you, in private sector
and
bank, the most important criteria, the most important I'm saying, is the management. You need to understand the philosophy of the management. So, for example, Kotak Bank trades at a multiple, at a premium valuation only because of the Uday Kotak, or HDFC Bank used to trade at a premium valuation only because of the earlier management. So, I think the management is the most important part in private sector or public sector bank, because that drives the so that basically drives how they want to disburse, which kind of clients they want to choose, which kind of sectors they want to choose, or whether they are running behind the return on asset, or they are running. So NPA or the credit quality is the most important criteria for them. So all these parameters comes with the management. So if the management is more conservative, he will prefer better credit quality rather than growth. If he's more aggressive, then he will say that I don't care about the credit quality, I'll rather focus on growth. So a different management will have a different philosophy. So in private sector banks, I would say management is the only criteria that one should be for looking at. Only, I would say.
Right, sir. So, sir, quickly, like 2-3 sectors, chemical, pharma, you already talked about. Any other sectors you see like tailwinds or maybe part of mega trends?
Different sector I see is going to be another big structural story from here. And there are very few defense companies right now. So whatever defense budget is going to be announced, these are the players who are going to get it, because the cycle in defense is very long. So it's not like 1 year, 2 year, 3 year. It's like 6-7 years they need to work with DRDO or other defense research organizations to get the prototype done, to get the validation done. And once they get the prototype or the validation done, then they get the commercial orders. So it's not easy for any new player to come in now and start making money. So the old players which are there in the defense sector will all benefit. So I think defense sector will do great returns.
Right, sir. And like, sir, previously you had a few, of course, the government interference sectors are the one. So, do you have the same view on infra which you had a year or 2 year before, or do you see
So
it differently now?
infra is definitely, I'm negative on infra. Defense is again, it's a, so there is a business government to company. So there you need to get order from the government, but there you need to understand there is a difference. So here I am not talking about Bharat Electronics. Okay, I am talking about private companies in the defense side. So there is, obviously there will be a lot of orders from the government side, but also there will be offset agreement which will benefit these private defense companies. So that's where basically I like defense sector as. So today I think this is in the structural story for next 10 years. Infra, I remain negative on infra only because it works still on the L1. So whichever businesses run on that L1 tender kind of story, I think they are not good businesses.
Right, sir. Last two quick questions, sir. How you see the paint space at this point in time with so many new entrants to it?
So I think paints. So again, it's going to be very, very crowded space, and so everyone getting into the peripherals. So JK Cement has acquired the paint. So everyone is getting into peripherals. So looks like there is going to be good competition. So growth will be a challenge for existing and even the new players. I don't know how many will really succeed in front of Asian Paints, but currently looks like there is going to be too much of competition.
Right, sir. So let me put an indirect question to a direct question. You can obviously say no if you don't want to answer. So what's your view on a management which is ethical and a good management per se? But if that is making capital allocation in something which has regulatory risk and all, and apart from that, if the management is also setting targets or maybe that kind of thing, so how you read it?
No, I didn't get this question. Is it related to Laurus?
Yes, yes.
Okay. Okay. So what allocation you are talking? Which allocations?
I mean, see, the higher regulatory scrutiny, say OIA and US FDA warning risk at some point in future. ANDAs are commodity game, and we have seen what happened to large caps. So on that front, I'm asking, sir.
So see, Laurus is not about. So I always keep saying Laurus is all about CDMO and bio business. So if you actually do the valuation of Laurus, then majority of that value actually comes from the CDMO and bio part. Now, when you look at CDMO business, look at Divi's Lab. Okay, they are doing it since last 20-25 years. Today also they say that 50% is CDMO, 50% is API business, which is a generic API business. Look at Suven Pharma. It's again a 20 or 25-year-old company. They are doing CDMO. Now they are basically saying that we are getting into value formulation part, so A&A parts, right? So what does that mean? So basically, with CDMO, you can't achieve so if you want to achieve a scale, okay, in CDMO you can achieve a scale to a point, up to a point, right? If you want to go beyond that, then you need to find avenues to grow beyond that, and that's where basically these people have kept API generic API going in case of the Divi's or Suven, they are getting into formulation side, and that's where but you need to understand in case of Laurus, so they have got their formulation business has got two parts. One is the contract manufacturing part, where they are not exposed to any regulatory risk or any pricing risk, and second part is their own formulation, which is anda. In andas also they are getting into andas which are, so they are trying to choose. So this is something similar to, I would say, natco strategy. So they are trying to get into andas where they have para 4 filings, or they are going to have first to FTF status. So they are not going after 200 300 NDAs every year. something similar to what Lupin or Aurobindo does. So they file almost 150, 200 ANDAs every year. So their business is basically filing is their main business, right? So that's not the case with Laurus. So they are not in the business of putting 100 ANDAs every year. They are trying to choose the molecules where they see there is an opportunity for them, where they are vertically integrated. That's where only they are basically filing the ANDAs. So whatever ANDAs they are filing, they are fully integrated in those particular ANDAs. So they will have a cost advantage in that. And that's where basically, so that's the differentiation between, this generic part and the other generic players. I think I
Right, sir.
answered to some extent, I guess.
Yes, sir. So, Sajal sir, before we close, any follow up on this, or are we done for the day as far as question is concerned?
नहीं मेरे तो सारे सवाल हो गए. बाकी किसी को कुछ पूछना है तो आई सी गुरमीत पाजी इज हियर. सत श्री अकाल पाजी. अरे वो स्पीकर लिसनर ही है यार, ये क्या बात हुई?
So, sir, I just saw him. I sending Jeevan sir. How good we are on time? Because we discussed till.
If you want to ask. So we can have a last question from Gurmeet if he wants to ask. I think.
Okay, great. We have Gurmeet sir. Gurmeet sir, over to you.
Sat Shri Akal, Sajal Bhaji, thank you. I just came in because I saw you and Jeevan speaking. I thought let me, get some pulse of wisdom. Nothing much to ask. I think I just joined and Jeevan covered about what is Laurus up to and all. In general, I thought that I think one my learning, and I would ask you if you can add some thoughts to it. That my learning in last, especially post COVID, is that the cycles have really shortened, and what goes in and out of favor, so one is the fundamentals around the business, and second role which causes a lot of price deviation is the sentiment around it. So all this API CDMO was the darling of the market in COVID. Then IT was the darling in 21. Banks nobody was willing to touch. Today nobody is willing to touch IT and pharma both, and everybody is gung on banking. And this can change very quickly. Suddenly rise in COVID cases, and we've seen a glimpse of it. So so how important it is to it's difficult to see your stocks go down 30-40%, but how important what should be one looking right now in some of the pharma names, if you could in the interest of everyone, what is a good story to add over the next, let's say, few quarters or a few
So
months?
as I explained earlier, right? So I always try to look at right sector and then right business in that sector. So what you said is right. The cycles has been shortened, but I don't believe on. So my framework basically tells me that you need to find stocks which will be deliver irrespective of the cycles. So that's where I say that I will go for a specialty kind of story of the sector. So in IT, I will not go with Infi or TCS. I'll go with say Tata Elxsi or KPIT or something similar. Obviously, I sold Tata Elxsi when the valuation became very, very high. But still, Tata Elxsi is going to be a structural story. It's going to be a story which will keep performing. So I'm talking about the earnings right now. Okay, I'm not talking about the price. So price, as you said, is always a function of sentiments and valuation on a lot of things. But if you look at the earnings part of say Tata Elxsi, right, that earnings will keep on rising every year. So at some point, people have to give that valuation again. So obviously, at some point, it started trading at 100 PE, which was unreasonable, and that's where it basically corrected. But is there any impact on the earning? The answer is no. The earning is rising. Earning is going to go up from here on as well. So I am saying, if you are choosing the right business, then earnings will keep growing irrespective of the cycle. The cycle has shortened in terms of the stock prices, not in terms of the earnings. Earning cycle has not shortened. If the business is good, they will keep growing earnings. Commodity cycle will be shortened. So commodity businesses will have earning cycle. But the specialty businesses will not have earning cycle. They will keep growing. That will be secular. So I will focus more on the business part rather than the price part. So price will definitely come back if the earning is growing. Is it?
Yeah, thanks. Thank you. I think that made sense.
Yeah. So even in the bank case, right? So today people are saying banks are going up and nobody was touching them 6 months back. But in the banks, if you are having a better, business, then I think that will keep delivering earning every year. So forget about the price action I'm saying, but if the bank is good and the management is delivering, so it's a secular business, right? So so HDFC Bank, their multiple can shrink, but I'm saying their earning hasn't shrink. So the earning is still growing.
Right, sir. So we are done with almost all the questions which we can take apart from stock specific questions, and there are many requests in pipeline which we keep for our next session, maybe sometime down the line. So thank you so very much, Jeevan
एक
sir,
एक
for your time.
क्वेश्चन गुरमीत पाजी के लिए है मेरा. If he's willing to, I know you track the API CRAMS space as well, Paji. So what could be the valuation criteria, and is there anything that you like today, or maybe if the correction continues for another week, 2 weeks, whatever, कुछ कुछ ऐसा अच्छा लग रहा है जो ध्यान से एनुअल रिपोर्ट पढ़ना चाहिए, या ट्रांसक्रिप्ट उसकी अर्निंग्स की पढ़ना चाहिए, या मैनेजमेंट पे कंफर्ट है और वैल्यूएशन अभी नीचे आ रहे हैं या आने वाले हैं, समथिंग अलोंग दोज लाइंस. रीजन बीइंग कि मुझे पता है आप ये स्पेस काफी अच्छे से ट्रैक करते हो, तो आपका पर्सपेक्टिव भी इम्पोर्टेंट है.
Thank you, Sajal bhai. I mean, I've learned about this space from you. I'll tell you what I think, and and I am a balance sheet guy, and I understand more on financials. And as Jeevan also made this point, a lot of the companies, I like this CDMO space. I think, and I made this point earlier also that CDMO is like pharma outsourcing. So what's happened to IT outsourcing with Indian IT companies in the last 20, 30 years? I believe it will happen in the pharma also. And for me, this is a 10, 15-year story. So I really don't get bothered about prices falling. So for example, I bought Divis in 2015 जब 500 रुपये था तो मुझे फर्क नहीं पड़ता है कि for me it's still a decent 6-7 bagger over a 7-year period. I'm very happy with it. So I know the valuations, and these businesses are lumpy. When Molnupiravir and Tolupiravir approval came, the price also ran up from 3,000 to 5,000 in no time. So the nature of the business is that it is lumpy, and I'm not, here making a stock recommendation here. And you need to weather that. Where we miss out is on the positioning and the sizing. We sometimes get too carried away and we don't do risk management properly. So if you have this space at normal exposure, it is fine. So I was attending the DV con call, and and they highlighted the several opportunities they got in last 6 months in the custom synthesis segment, and a lot of them are mainly in phase 2 and phase 3, which could commercialize in the near term. They've obviously keep filing multiple DMFs, in regulated market in the API segment also. And obviously they got also badly impacted by RM prices and solvent prices. These problems don't remain always. So for businesses like this, you need to have a great domain knowledge like you have, Sajal Bhai, and a lot of people. Aditya Khemka is somebody I follow very closely. Second is your patience and the ability to hold. And I remember, that Peter Lynch dialogue that every successful investor you see, it's what they do in down cycles is what has differentiated them. It's not
करेक्ट.
just the stock picking, right? What you do when something will keep going wrong. वो कहते हैं ना ट्रेन का आखिरी बोगी तो हटे रहेगा ही कोई ना कोई. But the engine can change ना when the stations change, and that you have to be very mindful of. तो थोड़ा सा ये हमको ना क्विक ग्रेटिफिकेशन इस आदत पड़ गया है क्वार्टर ऑन क्वार्टर रिटर्न का, हर महीने में कुछ जल्दी बन जाए. ये क्विक मनी सिंड्रोम इज व्हाट आई एडवाइज एवरीबॉडी ऑन द कॉल टू गेट रिड ऑफ, and I think then your journey is very, very comfortable.
Yes.
100%.
This
Thank
quick money, I think what has happened after COVID is everybody has got the different expectations from the market. I think that's where the thing has become different. So I think that return expectation has to become reasonable now, and that's what market will do. Obviously, market is the best teacher.
Yeah.
So I
You
think
know,
that will happen.
even why
So
I was hearing the Reliance AGM and Mukesh Ambani made that point that they want to double the enterprise value by 2027, and there was a standing ovation. There were tweets around it. वो
correct.
15 टका ही बोल रहा है 5 साल में.
Yes,
He
yes,
invested billions of dollars. He spent, doing capex, setting up gigafactories, getting into
yes,
new energy businesses. उसका
yes.
expectation 15% है, हमको 15%, we have to make in a month in Reliance. So that is
So
the problem.
15% return expectation was considered very good expectation
Yeah.
before COVID. So everybody was like, if I get 15% from the market, it's a very good return. Now 15% is like they want monthly. So I think that will be reason that will become reasonable over time. So let's perfect. Perfect.
So,
Thanks a lot.
Jeevan sir, with your permission, I know we already took so much of time. One relevant question has been asked by one attendee. I read it for you,
Yes,
or
yes,
shall we take it
yes.
next time?
Yeah, you can.
So he's asking, in the US biotech industry, we see 20% plus job cuts plus project pipelines being closed. Does that translate to reduced revenue to CRO industry cause of the cash crunch and cash runway extension? Is the revenue inversely proportional to US interest rate?
So, see, what has happened in case of US biotech maybe is because the funding has got little dried up. Okay. But if you look at Indian CDMO companies, the size is still very, very small. So, just look at the largest CDMO company in India, which is Divis Lab, right? Their CDMO business will be like 3,500 types. Correct me if I'm wrong, Gurmeet ji. So, I think CDMO revenue will be 3,500 crores. So it's still very, very small. So Suven Pharma has got 1,300 crore revenue from CDMO. Laurus will have 1,200 crore CDMO revenue. They are still very, very small companies. So I don't think that will have any impact on Indian market as yet. So it's still time we become relevant in that CDMO industry, in the global CDMO industry, I would say.
एक चीज मैं ऐड करना चाहूंगा यार डिवीज का कि आई ट्रैक इट वेरी क्लोजली एंड आई एम आल्सो इन्वेस्टेड एज अ डिस्क्लेमर. इसका जो 3500 करोड़ का जो सीडीएमओ बोलते हैं ना, वो पूरा का पूरा ऑन पेटेंट मॉलिक्यूल्स नहीं है, वो उसमें जेनेरिक भी इंक्लूडेड है, और ये वो वाले मॉलिक्यूल हैं जो वो इनोवेटर्स को दे रहे हैं. सो दे क्लब इट अंडर सीडीएमओ, जस्ट लाइक गावापेंटिन को सीडीएमओ बोलते हैं कुछ कंपनीज.
Okay.
ठीक है ना. और दूसरा ये जो क्वेश्चन है ना कि 25% जॉब लॉस, ये वो, तो देखो जब बेल्ट टाइटनिंग होती है, लास्ट टाइम आईटी को बेनिफिट हुआ था आउटसोर्सिंग में, क्योंकि जब देखो तुम्हारे पास पैसे कम है तो तुम्हारे ऊपर गन आ गई हेड पे, यू हैव टू आउटसोर्स इवन मोर. क्योंकि हॉस्पिटल्स में पेशेंट्स मरना नहीं बंद हो रहे हैं, आईसीयू फुल है, यहाँ पे वेटिंग है. कम टू यूरोप एंड एक्सपीरियंस इट सम टाइम. यूएस जाके एक्सपीरियंस करो तो पता चलेगा कि हेल्थ केयर इंडस्ट्री में चल क्या रहा है. वहां बैठ के ट्विटर पे न्यूज पढ़ के तो बहुत लोग बहुत कुछ बोलेंगे. ग्राउंड रियलिटी इज दैट द डिजीज pool is increasing, the complexity and the variety of different types of जिसको बोलते हैं ना रेयर डिजीजेस. जो जिनकी प्राइसिंग पर ड्रग, जिनकी प्राइसिंग जो है ना वो एक्सॉर्बिटेंटली हाई होती है. पॉपुलेशन मैट्रिक्स जो सफर करती है उन डिजीजेस से वो कम होती है, बट यू प्राइस देम एक्सॉर्बिटेंटली हाई. और उस तरह के बहुत सारी इंडियन कंपनीज जो हैं वो क्लिनिकल ट्रायल्स, फेज 1, फेज 2, फेज 3, इवन कमर्शियल एज वी स्पीक, Indian companies are supplying, making those products at scale and supplying them commercially. तो मेरे हिसाब से तो ये फेवरेबल होगा कि यूएस अगर रिसेशन में जाता है तो आउटसोर्सिंग इंक्रीज होगी.
Yes, this is
अगर
good.
आप Q1 की कॉल सुनोगे सिंजीन की, एग्जैक्टली यही क्वेश्चन किसी एनालिस्ट ने पूछा था, ये जून जुलाई के आसपास जो कॉल हुई है, तो उसमें जोनाथन हंट ने एग्जैक्टली यही चीज बोली थी कि इफ यू आउटसोर्स विद द सेम अमाउंट ऑफ कैश यू इंक्रीज योर रनवे. आपका ऑक्सीजन ज्यादा दिन चलेगा अगर आप इंडिया के कॉस्ट पे चलाओगे तो.
Correct. Very valid.
So thank you so much to everyone who attended and our eminent speakers for the day. Jeevan sir, thank you for your time. Any closing remark before we leave today?
Thanks a lot for everyone to listen patiently. See you again.
Thank you. And guys,